In March 2020, the Federal Reserve responded to the economic panic tied to COVID-19 by dropping its federal funds rate to nearly 0%. The federal interest rate governs how much banks pay each other in interest to borrow funds kept at the Federal Reserve on an overnight basis. This is known as the repo market, where firms trade trillions of dollars worth of debt for cash each day. During the height of the COVID recession, the Federal Reserve created permanent domestic and international standing repo facilities to keep Wall Street and the broader economy operating. These repo facilities allow eligible firms, who are mainly large banks, to quickly convert their treasury bonds into short-term cash loans. At the same time, the Fed implemented another monetary policy measure known as quantitative easing, the creation of new bank reserves, often referred to as printing money, to purchase government bonds. From March 2020 to November 2021, the Fed purchased $80 billion of Treasury bonds and $40 billion of mortgage-backed securities every month. This combination of increased bond prices and reduced bond yields lowered interest rates for borrowers in the real economy. A 10-year Treasury bond is often used as an indicator measuring investor confidence, particularly in the mortgage market. Because mortgage-backed securities are collateralized by a mortgage or a collection of mortgages, the low yield of a 10-year bond is translated into low mortgage interest rates. When interest rates and bond yields are low, fixed income allocations with lower profit margins become less attractive to institutional and retail investors, leading them to make riskier investments in search of higher returns. Yields on treasuries largely reflect investors' expectations for what short-term interest rates set by the Fed will average over the life of a bond. Longer-term yields are generally higher than shorter-term ones, because investors want to guard against the risk of unexpected inflation and rate increases. After months of the Federal Reserve increasing its federal funds rate, short-term yields now exceed long-term ones. This scenario is known on Wall Street as an inverted yield curve and is often seen as a red flag that a recession is looming.